Hi, grade 11s. Just a quick one on how to comment on the liquidity. So let me just quickly get my answer book here. Okay, so not liquidity, the profitability of a partnership. So they want us to quote and explain three financial indicators for profitability. And that means that we have to go to the information provided and we need to now first indicate or identify which one of these ratios can be used to comment on profitability. And that is your percentage gross profit on markup, and then your percentage operating expenses on sales, operating profit on sales, and then your net profit. Because anything with sales, cost of sales, profits, operating expenses, all of your socky ones will then be for your profitability. And that's the only information that we have received from them. So we will then use that. So you can decide which one of the three you want to use. So let's see what they have here. They have the gross profit markup achieved. So you achieved in the current financial year 40%. Last year, you made a gross profit markup of 30%. So there was an increase. So remember, we said that the first thing we are going to do is we are going to compare the prior year to the current financial year. So we are going to say that the gross profit markup increased from 30%. So remember, we said we must show the figures and then you must also include the year. So from 30% to 40% in the current financial year. Current financial year. Okay, so that's 2024. So that's your first thing that you are going to say. Then remember, there's no industry norm provided. There's no norm that we're going to say you must obtain this and you must obtain that. So we can just say that it seems like they've been managing their purchases, so the cost of purchases, more effectively in the current financial year, or it could be that they decided to increase the markup percentage because they realized that they weren't making profits and they were moving towards a loss. So they didn't give you the markup that they wanted to achieve. So in other words, they didn't give you the goal, so you can't compare it to that. So you are just going to say that it seems as though this partnership, oh my gosh, has been able to manage their cost of sales more effectively in 2024. Okay, so could be that you maybe are using a new supplier. So maybe they are using a new supplier at a better cost with the same quality. Remember, we said that we don't want to now increase our profit markup if our quality remains the same, unless, of course, the competitors have much higher markup. So then you can do it. But we usually say that if the quality remains the same, please do not just go and increase your gross profit markup by 10%. I mean, that's a bit excessive, right? So that is more or less what was happening here. Could have also been that maybe you decided to buy more in bulk, therefore saving, but it all comes back to you were able to manage your costs of sales more effectively. And it could also be that you applied less trade discount. So that's a big one. So less trade discount applied. In other words, you were better in managing stock purchases, So in other words, you didn't have to allow trade discount because you needed the sales. You purchased the correct stock. People liked your stock. They wanted to buy your stock at the profit markup. So that's what that is. Then your operating expenses on sales is the other one. So operating expenses on sales increased from 12.9% in 2023 to 19% in 2024. So now what does this mean? Your operating expenses increase from the one year to the next. So in other words, not you, the business has not been able to manage their operating expenses, effectively. In other words, we had more expenses than last year. This is not good. We need to cut costs somewhere because too much of our sales are now going in to operating expenses. That is also why you have a decrease in your operating profit, because you weren't able to manage your expenses effectively. Okay, so now I'm just talking through the rest, because now you know you must first compare current year to prior year, and then you're going to say what this means. And remember also that your operating profit on sales, we said that we want this to be around about 20% to be very good, but we want it to be at least above 10%. Now it is below that. So definitely not a good one yet there. Then your operating expenses also too high. You need to bring that down. Then your net profit percentage on sales compared to the previous year, that has improved. So because your operating profit on sales decreased since the previous financial year, but your net profit on sales increased, it could be that you had less interest that you paid in the current financial year compared to what you paid last year. You see that movement there? That was 10,1. Now it's 7,4. And the net profit was 7,4. Now your operating profit is 9% and your net profit on sales is 8%. So there's only a 1% movement. Here it's almost 3%. So less interest expenses. So that is at least something good. It means that you're trying to get rid of those loans so that you can have more profits after you have paid your interest. So overall, we are not satisfied with the profitability because we have not been able to manage our expenses effectively. We have not been able to retain enough of our sales to help us to grow this business again. Because remember, you want to take your profits and you want to reinvest it into this business to grow. But if you only have 8% of your sales left at year end, what are you now going to reinvest into this business to help it grow? There's no use in you reaching your target profit markup percentage or increasing that profit markup percentage if you can't manage your expenses effectively. So that's how we look at profitability ratios.